Hello traders, and welcome to another exciting episode of Forexer. Imagine possessing the ability to predict price movements by harnessing the hidden forces of liquidity and fair value gaps. It's akin to possessing a detailed roadmap to navigate market momentum, a roadmap we are about to unveil right before your very eyes. In this advanced episode, we will delve deep into the intricate interplay between internal and external liquidity, shedding light on how prices oscillate between them while bridging the gaps that define market equilibrium. Whether you're a seasoned trader or just embarking on your trading journey, comprehending this concept can provide you with a clearer perspective on price dynamics and potentially elevate your trading results. So, join us as we embark on a journey that has the potential to reshape your approach to the financial markets. Traders, if this piques your interest, please show your support by giving this video a thumbs up and subscribing to our channel if you are new. Traders, let's dive right into the concept of liquidity drawing. Drawing on liquidity entails the anticipation of price movements by considering liquidity and fair value gaps. This is undeniably one of the most crucial aspects of trading that you must fully comprehend before entering any market position. This knowledge empowers you to forecast the likely direction of price movements and the behavior that prices might display. For instance, it helps you identify potential retracements before a price makes a move either upwards or downwards. Market movements are primarily driven by two key factors that consistently influence price direction. 1. Liquidity zones. The market continually seeks to sweep liquidity to generate momentum. Liquidity essentially acts as the lifeblood of the market and plays a vital role in its overall dynamics and functioning. We've extensively covered how to identify liquidity zones in a previous video, which you can find linked in the description. If you haven't watched it yet, you can easily access it through the description of this video. 2. Fair value gaps. The market consistently displays a tendency to fill and rebalance the gaps that exist within it. For instance, consider the example where the price sharply dropped, leaving a fair value gap due to inefficiency. Subsequently, the price moved back up to fill this fair value gap. It also moved upward to clear out external liquidity. Once external liquidity was swept, the price reversed back down to fill the most recent fair value gap. This cyclical pattern reflects how the market operates, with prices aiming to both clear accumulated liquidity and fill fair value gap. Now, let's break down fair value gaps and understand how to identify them in the market. Fair value gaps typically take shape within a 3-candle sequence and are readily discernible on the chart as a large candle. What sets them apart is that the upper and lower wicks of the neighboring candles do not completely overlap with the body of the gap candle. This characteristic creates what we refer to as the fair value gap zone, which essentially occupies the space between the wicks and is drawn on the body of the candle itself. Imagine a scenario where the price undergoes a downward movement. In this situation, the fair value gap is also referred to as the liquidity gap, arising from the absence of buying pressure during this specific downward price movement. The identification of fair value gaps relies on a specialized method of gap detection, solely based on observing the candle's upward or downward movement in relation to adjacent candles. Candles outside of this range do not contribute to determining the gap. Preserving these empty pockets of liquidity is of significant importance because they can function as robust entry points in terms of market attractiveness for liquidity. When the price tends to move downward, its objective is to clear potential liquidity areas situated higher than itself. Consequently, these areas transform into favorable zones where the price may experience an upward movement, occurring only after the gaps are filled and then proceeding with its descent. When it comes to liquidity, we can categorize it into two types: internal and external liquidity. To better understand this concept, let's imagine a market structure like a rally wave comprising both high and low points. These high and low points represent external liquidity. Essentially, external liquidity relates to the highs and lows within a rally wave. On the other hand, the fair value gaps found within the range of these highs and lows are considered our internal liquidity. It's important to note that when you zoom in on a lower time frame, you'll come across numerous internal highs and lows, as well as various market structures. However, when you shift to a higher time frame, all of these elements would be perceived as fair value gap. In essence, internal liquidity refers to the price gaps or imbalances within the range of a market structure, while external liquidity pertains to the high and low points that define that structure, such as in a rally wave. Understanding these distinctions is crucial for a comprehensive grasp of market dynamics. In the market, price continually oscillates between two types of liquidity, internal and external. You can envision it as an ongoing cycle where price transitions either from internal to external liquidity or from external to internal liquidity. In simpler terms, price moves either from a high or low point towards a fair value gap or from a fair value gap towards a high or low point. This forms the fundamental movement pattern that the market adheres to. If we examine the schematic figure provided, it illustrates a rally wave moving upwards, sweeping the external liquidity accumulated above the previous high. Following this, the price shifts towards internal liquidity, as indicated by the fair value gap, to fill the gaps left behind from internal liquidity. The price then transitions back to the external phase, moving from the fair value gap to external liquidity by clearing liquidity above the previous high. Once external liquidity is swept, the price aims to rebalance by targeting internal liquidity. This prompts the price to drop and fill the most recent fair value gaps. In this scenario, after filling a fair value gap, the price is likely to pursue external liquidity. Now, the question arises, will the price move towards upper external liquidity or lower external liquidity? To answer this question, you should first consider the previous order flow of price on the higher time frame, or the order flow within the same time frame. This analysis helps determine the direction in which the price is more likely to move it. For instance, if you zoom out and observe that the price has primarily been in a downtrend, you would anticipate a downward break of the market structure. Consequently, the price is more likely to continue its downward movement to sweep the lower external liquidity. Conversely, if the price has been in an uptrend, the expectation would be that the price will rise to target the upper external liquidity. In essence, the historical trend of price movement provides valuable insights into the likely direction of future price movement in relation to external liquidity. If the trend has been predominantly downward, it suggests a higher probability of further downward movement to clear lower external liquidity. Conversely, if the trend has been predominantly upward, it indicates a greater likelihood of price rising to target upper external liquidity. Another crucial factor we can utilize to determine price direction is the price action that unfolds when price enters the fair value gap. If the price respects the fair value gap and demonstrates a strong rejection towards the upside, it suggests that the price will likely aim to reach the upper external liquidity. Conversely, if the price does not exhibit a significant reaction upon reaching the fair value gaps, it indicates that the price is more likely to move downward in order to target the external liquidity accumulated below the low. Now, let's transition to a real chart and examine some examples to illustrate these concepts. On the screen, we have a daily time frame chart of the euro-dollar. Let's analyze this bullish rally wave. Initially, the price moved below the low, sweeping the external liquidity present below that level. Subsequently, the price retraced upwards towards the internal liquidity with the objective of filling the fair value gaps. Following this rebalancing, the price reversed its direction and moved downwards to sweep the external liquidity. Similarly, another bearish rally wave was formed, which had already swept the external liquidity associated with the previous rally's low. At this juncture, the price shifted toward internal liquidity, indicating that it was time for the price to move towards the internal liquidity. Notably, the price moved towards the fair value gaps and experienced a reversal at the extreme fair value gap. Once more, we can observe another rally movement on the chart. Initially, the price swept the external liquidity here. Following this, the price exhibited a strong upward movement towards these three fair value gaps. However, it's evident that the price did not show respect for any of these gaps. Despite rebalancing these gaps, the price did not shift its direction towards the downside. Instead, the price pushed towards the upper external liquidity. What's clear is that after sweeping the buy-side liquidity and forming a perfect point of interest POI, the price promptly reversed its direction back to its primary direction. It's worth noting that the price is now poised to target the buy-side liquidity, indicating a significant reason behind this move. The buy-side liquidity has been swept, and the price is now eyeing the sell-side liquidity, aligning with its dominant direction. This potent trading setup is undoubtedly one of my personal favorites, and I've consistently aimed to capitalize on this strategy within my trading plan. In fact, I'm excited to announce that I'll be dedicating an entire tutorial to this strategy in our upcoming episodes. Let's proceed further. As you can see, the price exhibited a strong downward movement, effectively sweeping the low of the preceding wave, which can be seen as external liquidity. Following this, the price retraced upwards, moving towards internal liquidity and filling the fair value gaps. Upon rebalancing these gaps, the price initiated another move toward external liquidity, as indicated here. Just as before, the price managed to sweep this external liquidity with a lengthy wick and then pushed upwards to fill the gap of this fair value gap. However, as seen, the price experienced a reversal after this and resumed its bearish momentum. Thank you to all our viewers who have been with us until the end of this video. We appreciate your commitment to learning and growing with us. Stay tuned as we have some exciting videos and strategies coming your way soon. If you want to stay updated with our latest content, make sure to hit that subscribe button, like this video, and share it with your friends so that everyone can benefit from this valuable information. I also recommend opening a live trading account with Hanko Trade to experience the difference firsthand. You can find the registration link in the description. Wishing you all good health and happiness. Until the next episode, stay successful.